12 years ago, I had a stable job, no debt, and I was saving money every single month. But my net worth was barely moving. My money was sitting in a savings account earning 0.01% interest. While that might feel safe, I was falling behind everyone else. But after learning how to invest properly, I had generated over $500,000 in investment returns, built a $5 million real estate portfolio and a $1 million stock portfolio by the time I turned 37. In this video, I'm going to walk you through the 5 investments that made that happen, ranked from the one that contributed the least to the one that built the most wealth for me. Let's talk about that 5 investment. Number 1, Certificate of Deposits, also known as CD. A certificate of deposit is a savings product where you lock up a sum amount of money for a set period, typically a few months to a few years, and bank pays you a fixed interest rate in return. When you open a CD, you decide 3 things upfront, which doesn't change over the duration. First one is the deposit amount. The second one is the term, aka duration, how long you will leave the money at the bank. And third one is interest rate, how much the bank will pay you in interest. At the end of the term, you get your money back plus the interest earned. This is where I got started, and today they make up around 3% of my portfolio. A word of caution, I wouldn't put more than 5% of your portfolio in the CD. You might ask why? The main reason is that you can't take out the money before the maturity date without paying a penalty. And the second reason, it is subject to interest rate change in the future, meaning you will lock in low interest rate even if the rate changes after you open the account. So what is the best use of CD? Short-term cash you will need within 12 to 24 months, aka 1 to 2 years. But this is also the worst case for long-term wealth building. Even at 4%, once you subtract the inflation, you are netting about just 1% in real growth. They are not wealth building vehicle. They are a parking vehicle. If you want to get started, go to bankrate.com and search for the best CD available based on your capital amount and the preferred duration. Make sure the bank is FDIC insured. Open up an account with the bank from the list. Transfer your money and that's it. You don't need to worry about anything. What CDs gave me was something more important than the returns. They broke the habit of letting money sit completely idle. That shift from money in an account to money put to work somewhere intentional was the first step for me. But I needed my long-term savings growing faster, which led me to something more complex but also more rewarding. Before moving to my second investment, if you are interested in learning more about finding a great investment opportunities while working full-time, click the link in the description below to join our Entrepreneurship Mastermind program. Let's move on to number 2, Treasury bonds. Treasury bonds are loans to the US government. Simply put, you lend money for a fixed period and receive regular interest payments in return. Only difference is that it is the US government, not the bank. Currently, treasury bonds make up about 5 to 10% of my portfolio. There are actually 4 types of treasuries worth knowing. Number 1, treasury bills. Basically, it's a short term, 4 weeks to 1 year. It is highly flexible. Treasury notes, medium term, 2 to 10 years. Treasury bonds, it's long term, 20 to 30 years. And then I bonds, which is inflation adjusted savings bond. Composite rate as of early 2026 is around 3.11%. The primary benefit of treasury bonds is predictable income and stability, useful for the conservative layer underneath riskier holdings. But if you are a beginner, you need to be aware of interest rate risk. If rates rise after you buy, your bonds market value drops. One of the world's best investor, Warren Buffett, keeps Berkshire Hathaway's large cash reserves primarily in short-term T-bills for exactly this reason. Flexibility over yield. But for most individual investors, stick to shorter term bonds for flexibility. Long-term bonds only make sense if you have a clear multi-decade horizon. Stability matters, but I still did not have meaningful growth in my net worth until the third investment. You might ask, what is the third investment? That is actually index funds. Instead of trying to pick which companies would win, you can invest in the market as a whole to reduce your risk. So when the economy grows, you grow as well. One of the most well-known index funds is called the S&P 500, which includes the top 500 companies based on market capitalization. The average return is 8% after adjusted inflation, meaning if you invested just $500 per month for the last 20 years, you would have now 294K. The two funds I started with were VTI, Vanguard Total Stock Market ETF, and SPY, which is S&P 500 ETF. Currently, index funds make up about 30% of my portfolio. So what is VTI? It covers nearly 100% of the stock of the US investable market, including small, medium, and large companies. Whereas SPY mimics the S&P 500 index, providing exposure only to large cap funds, meaning the top 500 companies based on their market value. You can follow the 3-step process if you want to get started. Step number 1, open a free brokerage account. I would suggest Fidelity or Vanguard. It just takes 15 minutes to open a free brokerage account. Step 2, automate your contributions. Even $50 per month builds a habit. Step 3, buy one index fund. Search VTI or SPY. Invest whatever amount you can. I would suggest keep investing the same amount every month. Stay consistent, especially when markets are down, because that is when you are buying at a discount. One word of caution, expense ratio matters more than just people realize. VTI charges 0.03% annually. Many actively managed funds charge 1% or more. Over 30 years, that gap compounds into a significant amount of money. If you invested $100,000 and do nothing for 30 years, your investment would grow to $755,000 with 7% growth rate. But if you invest in managed fund who takes 1% management fee with the same 7% growth, your investment would grow to $575,000. So you would lose $180,000. But as with any investment in the stock market, your money can go up as well as down. So before you put your money at risk in index funds, you need to know what you should do during market downturns. In March 2020, my portfolio dropped hard in a matter of weeks. During the COVID crash, my balance looked terrible, but I did not sell a single share. Those same shares bought at the bottom are now worth multiple times what I paid for them. But the investors who quit during the downturns are the only ones who actually lock in the losses permanently. Research from JP Morgan shows that missing just the 10 best trading days in the S&P 500 over the 20-year period cuts your total return roughly in half. So don't sell to try to mitigate your losses. Chances are you will also miss out on significant gains when the stock market recovers. Let's move on to number 4, individual stocks. You might ask, if index funds are so great, why would you ever want to invest in individual stocks? Well, individual stocks can produce higher returns than index funds. If we talk about Warren Buffett, he made almost 20% return using individual stocks. And today, individual stocks make up about 15% of my portfolio. Some of my best returns came from individual stocks like Microsoft, Tesla, Nvidia. But they can also move the wrong directions first. My first experience, I put $400 into 3 speculative positions, a meme stock, a SPAC, and a biotech play I heard about on social media. All 3 dropped, I panicked, sold everything and lost the full 400. Looking back, if I had put that same 400 into SPY and done nothing, I would be up significantly today. But that loss was worth more than any book I read that year because it permanently changed how I approach individual stocks now. So today, here are my exact criteria before buying any individual company stocks. Number 1, consistent revenue growth over at least 3 years. Number 2, gross margins that are stable or improving. Number 3, positive free cash flow. Earnings can be adjusted, cash flow is harder to fake. Number 4, a temporary problem, not a permanent one. Ask, is this Netflix in 2022 where temporary subscribers slow down then recovered, or like Blockbuster, which model permanently broken? And number 5, insider buying during bad news. People inside a company sell for many reasons. but they buy for only one reason. They think the stock is mispriced in their favor. The biggest risk with individual stocks is not the volatility. It is overconfidence after a few weeks. A couple of good trades can make you feel like you have figured something out. You can beat the stock market. Usually you got lucky. The key is knowing which one it was. As famous investor Warren Buffett once said, if you don't want to own the company for 10 years, don't bother to own it for 10 minutes. He also mentioned, if you can't write the reason for buying the individual stocks in a piece of paper, most likely you are buying the stocks for the wrong reason. By this point in my investing journey, I had index funds, compounding, a few individual positions I believed in, and bonds underneath, everything for stability. But my net worth did not start truly accelerating until I finally started the investment I had been putting off for 8 years. And that is my point 5, real estate. Real estate built the majority of my net worth. Today, I own 22 rental properties across Nebraska, Alabama, Ohio, and Tennessee with a total portfolio value of approximately $5 million. Last year, those properties generated around $105,000 in net income after all the expenses like management fee, maintenance, taxes, insurance, capital expenditures, and mortgage payment. And the good thing is that I only worked 1 hour per week on my real estate investment last year. You might ask why real estate investment is different. Most investments give you one way to make money. Real estate gives you 4 at once. Number 1, borrowed capital. With an FHA loan, you can control a $200,000 property with roughly $7,000 down. No other mainstream asset class gives an individual investor that kind of buying power with so little capital upfront. Number 2, debt payment. Your tenant makes your mortgage payment every month. You build equity using their rent, not your own savings. Number 3, rent growth. Rents historically increase over time. Your fixed rate mortgage payment does not. And it also an inflation hedge. A $150,000 mortgage taken in 2015 feels significantly smaller in 2026. Inflation shrinks the real cost of your fixed debt every single year. All 4 of these forces work at the same time. No stock does that. My first property was a single family home near Redmond, Washington. I lived in the house and rented out the basement for $1,000 a month. That $1,000 covered roughly half of my mortgage payment. My biggest expense, housing, was cut in half because I made one decision. I was terrified before I did it. I was asking the wrong question. What if I get a bad tenant? What if something breaks? What if the market drops? Then I asked myself a different question. What if I don't do this? What if I am still renting this same apartment in 10 years? Still saving at 0.01%. Still waiting until I feel ready. That scared me more than any of the rest. Here's how you can get started as a beginner. With an FHA loan, the minimum down payment is 3.5% for a credit score of 580 or higher. On a $150,000 property, that is about $5,250 down. FHA loans can be used for 1 to 4 unit properties, meaning you can live in one unit and rent the others immediately. What is the requirement? You must occupy the property for at least 1 year. That is not a limitation. It is the strategy. You live there, understand the property, save from reduced housing costs, and then buy the next one. Keep in mind, debt to income ratio needs to be under approximately 43% to qualify. The biggest barrier is not the down payment or the credit score. It is the belief that real estate is for other people, not people like you. I sat on that belief for 8 years, but when I finally moved past it, everything else followed. If this video gives you a clearer picture of how to actually build true wealth and you want to go deeper on the exact systems I use, I put everything into my entrepreneurship mastermind program to help people like you. Real estate deal analysis, stock strategy, building income streams, it is all there, along with a group of people doing the same thing. The link in the description below if you are interested. I will see you there.